What's going on, internet? It is your boy Eric Bandholz. Why don't you guys come and take a walk with me? So today is going to be a fun episode. I'm going to talk about personal investing, stocks and bonds, all that good stuff. And for those who don't know this about me, I used to be a financial advisor for a big bank, one of the biggest, and did that for a couple of years, and of course developed a lot of opinions about investing, much like any other financial advisor you'll run into. I want to talk a little bit about my philosophy for investing, and of course you should, when it comes to finance, you should always consult with an expert. Don't just listen to me because I'm some guy on the internet. But I do think I've got a pretty good policy for it. See, the first things first, with personal advisors, or I guess financial advisors, whatever the name is, stockbrokers, whatever the name is that they go by nowadays, their time, most of their time is spent with you, the client. So what that means is they can get like an overview of what's going on in the market and kind of what's going on with stocks or funds that they follow, but they're not an analyst, right? They're not spending most of their time looking deep down into the details of funds. Their value that they are going to bring to you is going to be that of like an emotional consultant, like helping you deal with the ups and downs of the market, helping you understand how you should be pulling your money in and out, and not so much like a guy or girl who's going to give you great stock tips and make you tons of money. With investing, one of the things that you can learn early on that's really going to help you is investing is a way for you to preserve your wealth. Your career, what you do 40 hours a week, is how you build your wealth. Okay? So the only way that your investing strategy should be about obscene returns is if that's your day job. Otherwise, you've got to figure out a way to preserve wealth rather than build wealth. See, statistically speaking, unless you have some kind of access to information that no one else has, you're probably not going to be able to beat the market. And if you do trade on information that other people don't have, that's called insider trading, and it's illegal. And that's a topic for another video. So now that you understand how you need to be looking at investing, how you need to be looking at your relationship with your financial advisors, now comes like the theory of how the stock market operates, how the financial markets operate, and your investment strategy within them. So like from a core philosophy standpoint, you're either going to believe that the market is totally efficient, mostly efficient, or not efficient. So in a totally efficient market, that means all the information that is known about any company is reflected accurately in the price, and therefore your ability to essentially beat the market with insider information is not possible. Okay, if you believe it's mostly efficient, then it's kind of like there may be some opportunities, and if you believe that it's not efficient at all, that there's not full knowledge, then that's where you're going to be able to try to beat the market based on the information you're gathering. So my core root is that I believe the market is mostly efficient. And the reason that is because there are activities like insider trading which are illegal. So if someone's not legally able to trade on information they know, then that alone means that the markets aren't totally efficient, because the market's waiting for that information to be known publicly before it can react. So therefore, a company that is undervalued or overvalued based on insider information isn't totally reflected. So that's like the 2-minute spiel on that. So with a mostly efficient market strategy or market philosophy, the strategy needs to be, you want to generally pick up the whole entire market, purchase the whole market as cheaply as possible. And you're never going to beat the market, but you're going to get very close to performing at market rates. So how do you do that? How can you buy the entire market at very inexpensive rates? Like 100 years ago, you'd have to buy a crap ton of stocks, blend it together and refocus it. And then mutual funds came out with managers, and managers would build together portfolios that would diversify you. But today, there's an awesome tool called an ETF, Exchange Traded Fund. And a lot of these act in a way that mutual funds act, in the sense that they bring funds together, but you're able to trade them like a stock. And the advantages are, there's more liquidity to your fund, and then you also have some pretty unique capabilities when it comes to the more trading tools. But anyways, you also can get very inexpensive funds that get pretty close to the market. So personally, I invest in a ETF called VOO. It's Vanguard's S&P 500 ETF fund. And what it's doing is it's matching the S&P 500 essentially. So I'm getting exposure to the entire market by just buying one thing. And then it is the cheapest fund out of all the ETFs. So there's a Spider, and there's IVV, which is, man, I forget all these actual company names. But, so Vanguard VOO is the least expensive one. So that's, on the long run, that's going to outperform the other ones, simply because the cost of the fees are lower. Now, my buying process, the reason why I just buy one fund is I get economies of scale. So there are fees associated with when you buy and you sell funds. So you can minimize your own buying fees by just focusing on one fund. Now, I'm not all the way up to date with all the options out there. I think there's even some companies out there that allow you to trade for free if you have certain accounts. So there may be even cheaper ways than I do it. I pay like $10 per trade. But if I want to bulk sell more than I've bought, then I can lump them all together because they're essentially the same commodity. And then what you want to do is systematically purchase this fund. So like every week, every other week, every couple of weeks, you will have it automatically purchased. So you just dump that money in, and what you're doing with this investment philosophy is you're taking away your emotional investment to the market. You're making a systematic plan, and that process of systematic investing is going to take away the human element of it and allow you to have a portfolio that performs. Because actually, the portfolios that do the poorest are those that are tied to emotion. And people are like, oh, I want to get Tesla because it's this really cool car company and it's just going to do these things. And there's no looking into like the financials of the company. It's just like, I like their product, I want to buy it. Or it's like, oh man, the stock market's tanking today, sell it, I don't feel comfortable. And what happens is you end up, when you ingrain the human element, for the majority of people, what's going to happen is you're going to end up buying high when things seem to be going good, and then you're going to be selling low, which is like the worst strategy you can have. So by systematically buying on a regular basis, you're buying high and you're buying low. Now, The other thing I want to talk about is your allocations of stocks to bonds. And a typical investment advisor is going to tell you you need to have whatever percentage of stocks to whatever percentage of bonds based on your risk level, tolerance, and all that. Well, the reality is you pretty much need to be capped out on stocks. Statistically speaking, over the past couple hundred years, over the course of like a 10-year period, bonds have never outperformed stocks. And if you're still buying, you always need to be in as much equity as possible to preserve the wealth that you've earned. Now, if you're in retirement, or you're approaching retirement, again, like you retire at 60, the single fact that you've lived to 60 means that you probably have another 30 years of living. The average age is probably like 77, but the people that are bringing that number down are dying when they're 20 or 30 or 40 or 50. So if you've made it to 60, you have a very high chance that you're going to live another 30 years. And if you're living another 30 years and you're putting all that money in bonds and cash, you are going to erode your wealth. And your investment strategy is going to be to lose the wealth that you've worked so hard to acquire, save up for. So stay in as much equities as possible for as long as possible, and have that systematic process that keeps you away from looking at the stock market. Guys, I love talking about investing, and this 10 minutes has flown by super fast. I'm going to maybe break this out into a little more chunks and go into a little bit more details if you guys find interest in this. So I'm not going to go on this too much if you guys really don't care about investing, but I love it. Preserving your wealth, growing your capital is a wonderful tool that allows for freedom and allows for you to do the things that you want to do in life. So shoot me a message down in the comments down there letting me know what you think. Do you like this investment talk? Does it help you with your life? Does it help you with your goals of what you want to achieve? And if it does help it, then cool, I'll produce more videos. But if you're not too keen on it, let me know as well. Negative feedback is cool. I'm down for it. As always, thanks for the walk, guys. Cheers, and walk on.